Welcome to Stock Trading Ninja Part 8, Day Trading and Forex. I'm Frank Bunn, your instructor. And before we get to the really important advanced tactics in the next segment, we're going to cover some of the best ways that I employ the strategy for short-term day trading intervals as well as the Forex markets. What we're going to see is that the universal trigger is ideal for shorter intervals, whereas it provides a ready-made, highly probable impulse that can be consistently traded and doesn't require excessive analysis. We can still achieve the high win rate we're looking for, and I've been able to routinely sample day trade intervals with 80% and 90% winners. I will show you how. We'll also run into the order entry challenge day trading presents. Risk and trade management strategies also tend to differ, primarily due to the time crunch. And we'll see in examples how the best setups evolve at specific times of the day. Our objective here is the most effective use of leverage, which for day trading is 4-to-1. We're also looking for higher turnover as well as a suitable method for hedging longer-term positions or buy and hold portfolios. So let's get started with the day trade guide. We want to focus on entries with the lowest setup risk, since the time crunch presents a serious challenge to more extensive intrinsic and contextual risk analysis. So we want to trade first and last hour reactions, as well as reactions to Federal Reserve news, which is usually around 2 p.m. on days when it is released. Included in the first hour will be 10 o'clock economic reports. The great thing about the universal trigger is that you're never trading the impulse, but always the reaction to it. So you can watch for the lowest setup risk entries. We'll also want to be using as much technology to reduce analytical burden and speed reaction time, as well as for risk calculation on the fly, position sizing, and R-game targeting. We want to be trading only listed high-volume index-type securities with very tight spreads. My day trade layout used to be about 150 stocks and 4 22-inch monitors side by side. Currently, I only use one 27-inch monitor, having created a more efficient page-based layout with more advanced changes in the newer versions of eSignal. Having recently completed a 3-year in-depth day trading research and analysis study with several traders, I have determined that the 3-minute, 5-minute, and 10-minute intervals have performed the best for this strategy historically, with some of the larger percentage winners and higher profit factor samples coming from the 10-minute interval, given that the time crunch is drastically reduced and it allows for more intrinsic and contextual risk analysis. The ideal mix for a watch list is lower beta stocks which are exhibiting high volatility and range. The strategy stop challenge is that many brokers and exchanges trigger stops based on the bid and ask prices, not the last trade. This presents a challenge given that the strategy stops into positions, so tight spreads are a must. I have also experimented with contingency orders in the form of pseudo stops, now available through many online brokers. There are additional tools available in more advanced commercial level 2 programs such as DAS or Realtick. Let's take a look at a few examples. Here we see a first hour MACD signal line system entry off the day low, and 2 signals generated on a recent first hour 5-minute interval chart of United Technologies. The MACD signal line system furnished the universal triggers you see here. Notice how the trigger evolves naturally after the impulse. In the first short, the stock was breaking to a day low. After the reversal, the second long signal caught an extremely low-risk continuation in the uptrend. Here's an example of an opening range breakout short position in Apache Corporation on a 10-minute interval. Notice the pattern, a swing low followed by an inside interval and a 1-bar pullback, a classic continuation pattern. You'll see these over and over again in the first and last hours where you can catch big institutional buy and sell programs. Let's move on and address currencies. The challenge of Forex is leverage. The pip risk on pattern intervals within the reaction phases is generally much higher. So the focus here needs to be on very low intrinsic risk, which you're going to learn all about in the next installment, Part 9. Although I have tested the strategy on intervals ranging from 4 hours to 24-hour charts, I will seldom trade anything smaller than the 24-hour chart, for a variety of reasons, including the management challenge of handling positions where intervals end and begin overnight here in the US. You'll want to track the major pairs, those with the tightest spreads, such as the 4 listed here. And here's my list in each signal. Any of the singles which do not list another currency are those which cross the US dollar. You'll note also that I follow gold, and occasionally an exotic or two, here in the form of the NZD, the New Zealand dollar, because sometimes spreads tighten or very strong trends evolve, so I don't want to miss a big move. The limited numbers of pairs in Forex make scanning quite easy. Here's a recent setup in gold, very low risk, originating from an MACD signal line trigger. And here's a Euro-US dollar setup I recently had using the same system. In this example of the Japanese yen-US dollar pair, you can see a very low risk entry using the 6 and 18 period moving average system, which is one of my favorites. Notice the green candle 4 intervals prior to the setup. You can see I was ready for an entry here, but notice the third lower low, as well as the adverse 6 and 18 crossover down, which blew out the setup. Always follow the rules when it comes to excessive reactions and adverse indicator signals. Here's another entry in the yen-dollar cross, with the 618 system triggering the entry. These types of moves are not uncommon in the Forex markets, and I am able to achieve those 3 and 4-to-1 risk game targets. You'll learn that the universal trigger tends to evolve in very strong impulses. It is just the technical nature of the trigger itself. So what we want to take away from this segment is the truth of the universal trigger, and the swing high-low pattern should function with similar results in any liquid charted security, the only difference being trade mechanics such as order entry and order management, as well as risk control and trade management differences found in disparate markets. In the next segment, we're going to be covering all kinds of tips and tricks to kick your game up a notch. So please review any of the basic logic and system entry material presented to this point. We're going to build on the basic strategy and explore the more intuitive aspects of intrinsic and contextual risk. So see you there.